You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 16th of December 2023, and I'm joined by my co-host, John McEwen. In this week's episode, we'll be discussing Inditex, AJ Bell, Currys, Supreme, Frasers, and our US company of the week is Wix. John, do you want to start us off with Inditex?
Yes, so it's one of our favourite retailers, European technically, but Inditex, it's the owner of Zara. They had the third quarter results out, with Inditex seeing sales growth of 14.9% to 25.6 billion euros in the first 9 months of the year, ignoring the impact of exchange rates. This reflects growth across all of the brands in all of their geographies. Operating profit rose 24.3% to 5.2 billion euros, as sales growth has continued to outpace rising operating costs. The costs are showing early signs of slowing, but they have continued to move higher at double-digit rates. The net cash position, including lease liabilities, increased from 4.4 billion euros to 6 billion euros, helped by a lowering of the inventory levels. Between the 1st of November and the 11th of December, sales were up 14% on the same period last year, and the optimization of stores is ongoing, with gross space expected to grow between around 3% this year, and that's despite 600 fewer open stores. Shares were broadly flat following this announcement. Valuation, Inditex, I should say, has a market cap of around 120 billion euros and trades at 21 times forward earnings, below its average, which is a 10-year average, which is 24.4, and it currently yields in the region of 4%. I thought these results were really, really good. It's a difficult environment, as we keep saying. Zara, or Inditex, its parent company, is an excellent retailer. It had some difficulties, I know, in Spain with staff striking and getting higher pay, but in response to that, the self-checkout tills are going well. So is online. They're maintaining their margins, and they've got the excellent supply chain visibility that we always talk about. Difficult to fault the way that they're operating the company at the moment, and it's still producing the results. I guess the difficulty is when it always, as we say with Inditex, it's highly priced for a retailer. I haven't checked Next that recently, but it's been around 15 times earnings, whereas Inditex, it's significantly higher at 21, but the results are really good. Sam, what are your thoughts on Inditex and the most recent results, and then the valuation?
Well, the results were absolutely fantastic. I think the revenue growth, pretty decent, 14.9%. But to be getting that out of fewer stores, really, really impressive. So 600 fewer stores, but they've managed to increase the space by 3%. So they're obviously getting more out of the current stores. And you can see that because obviously the revenue is going up, but then the costs are going down. And that's why the operating profit is up so much more than the revenue at 24%. Really, really smart management. We've followed this for a couple of years, and it's just a really, really high quality business. One of the highest quality retailers that you can buy, probably, I think is fair to say. But you've got to pay up for it. And I think with stuff like the store optimization, it's really impressive that they've done it, but it's the kind of thing where they're not going to be able to do this quarter after quarter after quarter. Eventually they will run out of levers to pull. And I just think it's already such a big company. Maybe it'll prove me wrong, but I just think it's already so big and it's quite expensive at 21 times earnings. I just wouldn't be comfortable paying that for a business of this size, but it is such a well-run business. I cannot fault the results. I can only fault valuation, which obviously the company has no control over. It's a business that I think when we first started covering it, I was sort of, well, it's retail. I don't really like it. I think it's such a well-run business that at the right price, I probably would be interested in buying it at this point. So it has won me over, but I would be wanting to buy it at a price that is just so much below the current price that I'm probably never going to get it, which is fine. But in terms of the business, it has won me round the more we've covered it. It's just such a fantastic, well-run business. I don't really know how it does it, to be honest. We've got some other very good retailers, but I almost feel like, if we compare it to like Next, Next, I think the success of Next is more explainable, where it's just got this fantastic like distribution network, and obviously the online platform is so successful. Whereas Inditex, I know like a good amount of the figures are online. I think we said last time they were working to like 30% or something online. But I don't really understand. I don't know if it's just the power of the brand, but I don't understand how it's able to keep putting up the figures it's putting up. It's just so impressive.
I mean, one thing people always say is it's very fast to react and it's always on trend. So that kind of being unique in terms of unique on the high street, assuming you're not going for the designers themselves. So maybe it is that fact.
Well, is that a cultural thing that they can hold on to, or is that a few key executives where if they were to leave, it would
Yeah,
just start becoming much more reactive, like
yeah,
the other high street retailers? That would be
yeah.
my concern with it.
So I suppose that's, in a sense, at the moment, it's an asset to the company, but how long
Mm.
can they maintain that? And if
For all
anything,
we know, that could be one operating officer at the top. And if
yeah,
he leaves and gets replaced by someone a bit more average,
yeah,
you just see it start trickling down to everyone else. But equally, it could be a cultural thing where, you
mm,
could change quite a lot of people at the top and that culture would remain. I don't know.
yeah, yeah. Okay, right. On to another company, AJ Bell.
Yes. So AJ Bell, the popular investment platform that we have covered multiple times, have come out with their full year results. They have announced record financial performance with revenue up 33% to 218 million and profit before tax up 50% to 87.7 million. Profit before tax margin was 40.2%, and that was up from 35.6%. Diluted earnings per share were up 46% to 16.53 pence. Final dividend of 7.25p per share is proposed, which increases the dividend for the year by 46% to 10.75p a share, in line with the company's stated dividend policy. They've increased customers by 50,880 to 476,532. And they've had net inflows of 4.2 billion, which was down from 5.8 billion the year before. They've got record assets under administration of 70.9 billion, and that's up from 64.1 billion, which is 11%. That's driven by net inflows across the platform and favorable market movements of 2.6 billion. The customer retention rate remained high at 95.2%, although it's down slightly from 95.5% a year ago. They've said that their Trustpilot rating is 4.8, which shows consistently high customer service levels. And on AJ Bell investments specifically, the record net inflows in the year of 1.65 billion were up 50% versus the prior year, and assets under administration was up 68% to 4.7 billion. In the CEO's statement, Michael Summersgill, I'll just read a part of it out because a lot of it's just repeating what's in the results, but he said, we approach 500,000 platform customers. This year, we've increased the interest rates paid to customers several times and will soon be increasing them further, with a particular focus on pension drawdown, whereas a customer needs to hold cash to fund income payments. We continue to invest in our customer proposition. In the direct consumer market, we've recently added the option to purchase bonds and gilts online in response to increased demand for these investments in the higher interest rate environment. Our free pensions finding service has proved popular with customers trying to track down and consolidate lost pension pots. And next year, we'll be expanding this into a low-cost pension consolidation service. This will enable people to find and automatically consolidate their existing pensions into one simple pension with ready-made investment options and a single annual charge of between 0.45 and 0.6%. And in terms of the valuation, the business trades at a PE ratio of 19 and it has a dividend yield of 3.46%. I think these are really, really impressive results. Really, really good. It's risen on the back of interest rates, I think, because of all the customer cash they're holding. I think also the stock market is starting to do a bit better, which helps as well.
Yeah.
My concern with it, and this is a concern I've been late with, and one that John was voicing a lot earlier than me, but I think it is a commoditized business. I've slowly come to realize that a bit too slowly, unfortunately, for my Hargreaves Lansdown shareholding. But it's a pretty good business. But yeah, I think it's commoditized. I think there's going to be continual downward pressure on fees, which I know John will be able to talk a little bit more about in a second. And then on top of that, I think it's a very cyclical industry. I think it will rise and fall with interest rates and the stock market. So I think at 19 times earnings, given that interest rates are pretty high and the stock market's doing fairly well, I actually think it's probably quite expensive, given that I now do consider it to be a cyclical business. And I think the growth's pretty good, but that growth is really on the back of interest rates. If you look at the increase in customer numbers, I don't think it's good enough to justify a 19 times earnings on this business. But very, very good set of results in what is a very competitive and tough industry. John, what are your thoughts?
Yeah, no, similarly, can't fault the results. Really, really good. Best we've seen in ages. And the shares have responded to that too. But as I've said for a while, I'm a bit wary of Hargreaves Lansdown, AJ Bell, because I do think it's really commoditized. I know that just from my own experience, that's where I've gone. And it was funny because we were just chatting about it before the show. I've got a lifetime ISA with AJ Bell, which no issues at all with. But I got an email from them on Friday, and they did say, we're cutting all of your fees. And which, as a consumer, it's fantastic. But as a business, having to do that in response to the competition isn't great. And I think that is the main worry with AJ Bell and Hargreaves. And I know you've mentioned, Sam, as well, there's the sort of the brand and the loyalty and that there's someone to speak to on the phone. But I think the other services are getting much better on that. And we've seen Robinhood only very recently coming into the UK market. They're now also allowing, I think in the autumn statement, they're going to allow you to be trading fractional shares within the ISA wrapper, which they weren't previously. So I think those sorts of things are even more of a concern going forward for these businesses. And as you pointed out, Sam, it's not cheap.
Should we move on to a business that last time we looked at it was quite cheap?
Yeah, I can't say a huge amount's changed, which is Currys. They had an electrical retailer, for anybody who doesn't know, used to be more prominent and on lots of retail parks in the high street, particularly in the UK, but it does have its European operation. Anyway, they had their half-year results out, with half-year revenue falling by 4% to £4.2 billion, ignoring the effect of exchange rates, with sales declining in all of their regions. And that comes, as we said before, with consumer spending tightening and Currys shifting its focus to the more profitable sales at the expense of market share. Underlying operating profit increased from £29 million to £31 million. That was largely due to operational cost-cutting efforts. Net debt rose from £105 million to £129 million, and free cash outflow improved from £86 million to £10 million. That was helped by a reduction in the inventory levels. Full year and longer term guidance has been maintained. The sale of the Greek business is expected to complete in the first quarter of 2024 and should bring in net cash of around £156 million. The group decided not to announce a dividend payment, and the shares were up around 9% following the results. In terms of valuation, Currys has a market cap of £567 million and trades at 5.5 times forward earnings, compared with a 10-year average of 10. I don't like this business. I think it's got, again, it's very much commoditized, and it's not one that's managed, in terms of bricks and mortar, that's managed to create a hybrid model very successfully. I don't see a long-term future in it. I think the results I didn't think they were great. I know the market has responded, but I suppose given such difficult times that it's been experiencing in recent years, perhaps it was slightly, less bad than was expected. I suppose they did manage to increase the underlying operating profit slightly, and perhaps there's some sort of, getting a bit better control of things, bringing in a fair bit of cash by selling the Greek business. But for me, obviously that will help the debt too, but for me, just the way it stands, I just don't see a future for this business in the 21st century. So I'd be very bearish and very cautious about looking at it as a value play or a sort of turnaround, quite honestly. Sam, what are your thoughts on Currys and these results?
I also don't like the business. I think it's in a really, really tough industry. However, I thought these results were actually pretty good. I will explain why, because I know revenue's down, but I think the revenue decrease, they're just in a really tough industry. I think where the economy's been, sales are going to be declining. A lot of the stuff they sell is the stuff that you would cut back on when times are a bit leaner. So I don't really have an issue with the revenue decrease. I don't think it's as a result of the way the business is being run. I think it's just they're in a really tough industry, which obviously from a shareholder's perspective you don't want, but from the business's perspective they can't do anything about it. I think the underlying operating profit increasing is good, and I think we've seen a lot of cost cutting going on. It wasn't Currys, was it, that like dropped the heating temperature in the stores to save money, or was that someone else?
I can't remember actually.
One
It's
of
not
them
uncommon.
dropped
I
it
know.
by like a degree.
Well, I know
Um,
Nuffield, slightly off topic, but Nuffield, the health group, have some gyms, swimming pools, all of that. They switched off their saunas, they switched off their outdoor pools, and I think they turned the temperature of their swimming pools down. But yeah, it's not uncommon to be happening at the moment.
I can't see. It might not have been just so we don't get sued. It may not have been Curry's. I can't remember who it was, but one of the big UK retailers did
Yeah.
it about a year ago. But I do have to say I admire it. I think it's good cost cutting. But yeah, so I think the cost cutting is good and that's going well. But obviously, there's only so long you can do that for. It's kind of similar to Zara's store optimization. Eventually, you run out of costs to cut.
Mm,
The net debt rising from 105 to 129 million, I actually think isn't bad. I think last time we covered it, that net debt had rocketed up. So it has started slowing. And when they sell the Greek business, they could, in theory, pay off the full amount. So at least it's
mm,
not. I think last time we were looking and we were saying if this carries on, they could go bust. That doesn't
yeah.
look like that's going to happen. And the free cash outflow, although they're still losing money or losing cash flow, it's actually still it's a lot better. Or again, that is by reducing inventory levels, which they can only pull that lever so much. But I actually think selling off the Greek business, like they're in trouble, just get rid of it, use the net cash to pay off the debt. And what I really do really, really like is to see a business that is in trouble and the management acknowledge it and they just don't announce a dividend. Like, it's just so
Mm,
refreshing to see that because I could come up with a list of sort of 10, 20, 30 businesses that we look at fairly regularly in this position or similar positions where they just stick to the dividend because they don't want to upset the shareholders, even though it's not in the best interest of the business. But they're going into more debt. They're in a tough situation and they're just cutting the dividend, selling a part of the business to pay off the debt, cutting costs. I think management are doing everything right, but it's just such an awful industry to be in. Although I have like nothing but good things to say about how I think management are responding to the issues that they've got, I just wouldn't. There's no price that could attract me to Curry's. It's just not a business I'd want to be in. But I think credit to the management because it is quite refreshing to see management actually take what I would consider to be the right actions in a situation like this, and it is quite rare.
fair enough. Okay, then on to a company you do really like.
Yes, Supreme. So it's one we've covered before. It's one that I own, and they do a lot of things. So they've got the license for like Duracell and Energizer in the UK. They've got like a vitamins business. They've got like a lighting business, but the jewel in the crown really is 88 Vape, so the vaping business, which this figure's a couple of years old, but they did have a 30% market share of the UK vaping market by volume. And it's a business that we've enjoyed following for a couple of years and that I am a very happy shareholder of. So they have come out with their interim results and revenue was up 63% to 105 million. Gross profit was up 57% to 28.5 million. The gross profit percentage was down 1% to 27%. The adjusted EBITDA was up 88% to 15.2 million. Profit before tax was up 179% to 12.3 million. Earnings per share was up 182% to 7.9p a share. Net debt was up 36% to 19.8 million, which I don't really have an issue with. So one of the things they announced in the July investor presentation was that they're taking on this debt, but they're using it to buy businesses where basically they can just, because they're such a good operation, they can strip out all the costs and then just bring it over to like their Manchester production facility or something. So they're buying these businesses and the payback period is 2 or 3 years. So if they've taken on a bit of debt to do it, I've got no issue. And you can see obviously the revenue is growing by far more than the debt. So you can't really say it's not working. And the dividend is up 88% to 1.5p a share. They've said that the revenue growth of 63% was driven by the Elf Bar distribution opportunity, which generated 26.4 million of revenue in the period and has been reported within branded distribution in the segmental analysis. They've said they had strong organic growth of 8.7 million, which arose from lighting, 21% growth, vaping, 17% growth, sports nutrition and wellness, 17% growth, and the contribution of prior year acquisitions, which reported growth of 5.4 million. They've said that the adjusted EBITDA growth of 88% was driven by incremental revenue and improved margins, with very modest investment in overheads to support the reported revenue growth. In the operational highlights, they've said they've delivered a strong operational performance, further underscoring their unique operating model and product set. There's been a 25% increase in vaping production capacity of the Manchester-based manufacturing site to accommodate the manufacturing operations of all three vaping businesses acquired in the 2023 year and support further organic growth. They've rolled out and significantly scaled the new Elf Bar distribution opportunity, including new customer onboarding and extensive product testing, which demonstrates the company's ability to adapt quickly to new opportunities. And they've announced a number of proactive measures to combat underage vaping, which Supreme strongly believes should be adopted by all industry players. And these include reducing the use of colour in the packaging, discontinue the use of coloured hardware for all 88 vape disposables, use only age-appropriate naming conventions to describe 88 vape flavours, trade only with retailers and e-tailers who commit to having robust age verification controls in place, and make recommendations to retail customers to locate vapes away from confectionery. It's quite nice to see because there's not really any need for them to do that until any legislation comes in. So it's quite nice to see, actually. It's quite ethical of them. In terms of the outlook, they've said that the second half of the year has begun very well with continued growth across all divisions. The strong performance of the core business and the growing breadth of Elf Bar distribution, combined with tightly controlled overheads base, has led to the board to again significantly increase the expectation of full-year profitability. They now expect trading for the full year to be significantly ahead of guidance, with revenue of around 210 to 225 million and adjusted EBITDA of about 32 to 35 million, an increase of around 4.5 million compared to previously issued guidance, with around 1.5 million of the incremental adjusted EBITDA arising from the core business and around 3 million from the Elf Bar distribution. Oh, they said the consultation on possible new UK e-cigarette regulation ends on 6th of December, so it's ended 10 days ago. The group remains confident that the government will continue to recognise the important role that the vaping industry plays in delivering the country's Achieving Smoke-Free 2030 initiative. Supreme remains ideally positioned to deliver ongoing profit growth, and the board remains confident in its ability to manage change. And in terms of the valuation, the business trades at a P ratio of 7.6% with a dividend yield of 2.63%, although that was well, but that's on the historic dividend yield before the increase of 88%. As a shareholder, I can't really find anything to criticise in here. Obviously, there's quite a bit of industry risk. We talked about the UK consultation. However, you would hope that vaping and e-cigarettes are part of the solution. And I do think that the data does suggest that. I appreciate that it isn't always driven, politics isn't always driven by the data, but yeah, really, really happy with these results. Nothing to criticize. It's cheaper than when I first bought it. I wouldn't be against adding to it. I really, really like this business, and I just cannot criticize the results or the management. John, as a neutral, what are your thoughts on the results?
I thought these results were excellent. I don't know. Well, I can't see anything that you could really criticize the performance on. I suppose what I was going to come back to you on, Sam, was it does on paper appear very cheap. What do you think that's really reflecting? Do you think that is the industry risk, or is there anything else that you see as sort of, I suppose, headwinds or fundamental problems with the business?
I think it's the industry risk. I don't think there's any issues with the business. I think it's just the industry, but I think because it's such a new industry, the vaping, which is now, the majority of the profits are now coming from vaping.
Yeah.
It's got so much exposure to this new industry, and we just don't know how the government's going to react.
Yeah.
They could come out and ban all the flavors for the disposable vapes. They could come out and just say, well, it's just menthol and tobacco. They could come out and just ban disposable vapes completely, which I don't necessarily agree with, because then you've got, one example that you have is, say you've got someone that has an e-cigarette and he's an ex-smoker, and they're out and the e-cigarette dies.
Yeah.
Assuming they don't want to wait until they get home, they've got a choice of a disposable or buying a pack of cigs. And if you take the disposable option away, some of them will revert back to cigarettes. But
and I guess that's one of the industry arguments.
That's the risk. You could just get an outright ban. I think e-cigarettes are probably a bit more secure, which they, a lot of the business comes from that. But for example, with the Elf Bar distribution, I don't know if Elf Bar do e-cigarettes. I don't know. I mean, Elf Bar really, they're known for the vapes, aren't they? And that would, that's driven a quarter of the revenue in this period, and that would just be wiped out. Now it's pretty low margin, the Elf Bar stuff, because they're just doing the distribution for it, although they are doing very well from the deal. But yeah, I think it's an industry risk because no one really has any idea what the reaction is going to be. But you'd hope that, I mean, at the minute, I think there's still so many people smoking because I think to start over-regulating vaping, you'd possibly be putting the cart before the horse a little bit. Although it is inevitable because once, if you get to a position, say in 10, 20 years where everyone's vaping and no one smokes at all, you're then going to start targeting the vaping. But so I understand why it's cheap to a degree, but I think a lot of it's just uncertainty. And that is just a risk you're taking. A massive chunk of the business could be wiped out overnight, depending on government policy. It is what it is.
No, fine. And I suppose that's the other thing with it. It's focused on the UK. It's not worldwide, is it?
So analysis of revenue by geographical destination. Of the 105 million revenue for the period, 97.5 million was from the UK.
Yeah.
So this is pretty much exclusively a UK story. So
the UK is a country that's keen on vaping, or the consumers are at least, but then it is all focused there. So if there is central or government regulation, it poses a big risk to this business.
It's a massive risk. That's by far the biggest risk to this business, I think. That a massive chunk of it just gets wiped out overnight. That's why you're getting such a good business so cheap.
Yeah. So. And if you did find that sort of whichever government is in power decided that they were actually very pro-vaping and they did see it as part of, a bigger part of the solution, then the upside is huge.
It is, yeah. Or even if they just leave it alone.
Yeah.
It is a massive, massive risk with this business. But
on to another British retailer, Frasers Group, formerly Sports Direct, had their half-year results out with half-year revenue up 4.4% to £2.8 billion, largely as a result of acquisitions made in the last 12 months. And underlying revenue grew by just 0.8%. Underlying profit before tax grew 12.6% to £303.8 million. And this uplift was driven by gross margin improvements as the group's product mix shift towards the more lucrative items. Net debt, including lease liabilities, rose from 1.2 to 1.3 billion pounds. Free cash flow improved from 140.5 million pounds to 216 million pounds. And the group is confident that it can achieve its full-year underlying profit before tax guidance, and that's expected to land in the region of between 500 and 550 million pounds. The shares were broadly flat on the results. In terms of valuation, the group has a market cap of 4.18 billion and trades at 10 times forward earnings, which is below its 10-year average of 15, and it's currently not paying a dividend. I think Frasers is one of those interesting companies. I mean, largely, if you'd looked at it, perhaps, what are we now, 2023? If you'd looked at it, closer to 10 years ago, it was much more of just the Sports Direct business. And then since Mike Ashley has handed the reins over to his son-in-law, there has been more of a strategy, and no doubt influenced by Mike Ashley, to essentially buy up a lot of struggling high street businesses. One of them, of course, was House of Fraser. It's been building up shares in Hugo Boss. It's been more recently building up shares in ASOS and Boohoo. So I think it's an interesting strategy that they're following, definitely less conventional. I'm not sure where it goes from here. And, obviously the Ashley family are essentially directing that future strategy. It's not clearly not doing too badly. It's not going great guns though, and its valuation is very modest. I'm kind of sitting on the fence and just watching it. I don't think I have strong feelings, but I would wonder where the growth is coming from. I think it's certainly risky buying the sorts of businesses, much less so with something like Hugo Boss, but with those sort of ASOSs and Boohoo's and potentially trying to influence the direction that they're going in. Sports Direct, the sort of pilot high, sell it cheap, it's a business model that you understand well. I'm less certain about all the collection, the portfolio that they're doing now. Appreciate there's trying to go to the higher margin business and cut perhaps more of the luxury items, but not overly convinced by the strategy, I'd probably say. So I'm just, continuing to watch with interest, but really sitting on the fence because uncertain about that wider strategy. Sam, what are your thoughts on these results and also the strategy that the business is adopting?
I thought the results were okay. Yeah, I mean, I thought the operating profit increase was decent. My main issue with it is the debt. I think the debt is, I know it includes lease liabilities, but it's 4x profit before tax, which I think is quite high. And I think that, and as well, I know they've got a lot of businesses that if they did get into trouble, kind of like we've just seen with Currys with the Greek business, they could flog some of the businesses they've got, but I would question the quality of some of the businesses that they're buying. So, for example, like Game, I don't know really how Game makes any money anymore because I think all the games are basically downloaded for everything. No one really buys physical games anymore. Whereas, compare that to when I was a kid, like every game I bought was probably in game. I was in there all the time. They've got some quite nostalgic brands, I guess, but yeah, I don't think it's in terms of the quality. I mean, there's a couple of high quality brands in there, like you've mentioned Hugo Boss, but the majority of it is just not particularly inspiring brands, and they're not brands that I'd want to own. I can't say I'd be fully comfortable with the strategy. So, for me, I just wouldn't ever be that interested in it because of the brands it's got. I probably preferred it when it's just Sports Direct.
What do you think about the valuation? Is it tempting you as a value play?
Not really, because I think for the kind of business it is, I think 10 times forward PE is probably about right. This isn't really a business that I don't think there's going to be massive earnings growth. Maybe if they can get these operational gains and they can sort of bolt on the right acquisitions and stuff, maybe there will be. But I don't see it as a business with massive growth in operating profit. I don't see the revenue growing that much either. So I don't see where the extra earnings come from. So you'd just be relying on a multiple change. It's not the kind of business I really see trading at 15, 20 times earnings because I just don't think it's a high enough quality business. So for me, I actually think the valuation is probably about where it should be. What do you think about the valuation then?
Yeah, I think it's probably reflective of the underlying businesses, they're pinning quite a lot now in going hard on Boohoo and ASOS. So I suppose if you saw a reversal in fortunes for those businesses, which as a shareholder I hope we do, then it could play out quite well. But no, overall it's not a business that I'm interested in. And I think the valuation, whilst cheap, is just reflective of perhaps some of those lower quality businesses in there.
Yeah, I agree. Should we move on to what I would consider a higher quality business?
Yes, and a much more expensive one.
It is, yes. So Wix, it's the online website platform. It's a business we have covered a couple of times before. It's a business that I own. They have come out with their Q3 results and they've announced the second quarter of consecutive positive GAAP net income. And they expect to achieve GAAP profitability for the full year 2023 and 2024. Total revenue was up 14% to 393.8 million, and these figures are all in dollars, which was ahead of expectations and marks the third consecutive quarter of year-over-year revenue growth acceleration. The incredible momentum in the partners business is demonstrated by partners revenue of 119 million, up 38% year-over-year, as growth accelerated for another quarter, with more partners joining Wix and monetization continuing to increase. Current business-to-business partnerships increasingly are driving growth, with a new multi-year strategic partnership with Intuit, further underscoring Wix as the online presence partner of choice for global marquee brands empowering small and medium-sized businesses. And they've also highlighted the early uptake of Wix Studio, the ultimate web creation platform for professionals, ahead of expectations with the global rollout now complete. They've had strong revenue growth and continued benefits from completed operational efficiencies, resulted in better than expected free cash flow of 62.8 million or 16% of revenue. They're raising full year revenue and free cash flow guidance, with full year free cash flow margin now expected to be about 15% of revenue, as free cash flow margin is expected to accelerate to 20 to 21% of revenue in Q4, above the expectations of the 3-year plan. Vishai Abrahami, Wix co-founder and CEO, has said as part of his statement that Wix's performance in the third quarter exceeded both growth and profitability expectations for another consecutive quarter, as we successfully executed on our strategic priorities while remaining diligent with managing expenses. The strength in our partners' business is especially noteworthy, with our team firing on all cylinders and revenue growth continuing to accelerate. We expect an extended growth period ahead of this business as we increase our penetration of the professionals market with higher monetization, particularly as Wix Studio continues to gain traction. Though early, we have seen a fantastic response to Wix Studio and an excellent adoption thus far. Finally, we continue to make tremendous progress leveraging AI to create frictionless experience for users with the recent launch of conversational AI chat experience for business. The first step in completely automating business management with AI to get businesses online more quickly and efficiently. This is just the first milestone launch in a string of very exciting AI product releases we have on the horizon. So just to break down the figures a bit more, revenue was up 14%. Creative subscriptions revenue was a majority at 290 out of 390 million. That was up 11%. Creative subscriptions annual recurring revenue increased 10% to 1.18 billion. Business solutions revenue was up 22% to 103 million. Transactions revenue was up 22% to 44 million. Partners revenue was up 38% to 119 million. Total bookings in the quarter were up 10% to 389 million. Total gross margin was 67% on a GAAP basis, and creative subscriptions was 82% and business solutions was 27%. GAAP net income was 7 million. We said net cash provided by operating activities for the third quarter was 64 million, while CapEx totaled up 19 million, leading to free cash flow of 44 million. Excluding the CapEx investment associated with our new headquarters office built out, free cash flow for the third quarter would have been 62 million or 16% of revenue. And in the outlook, they've said exceptional outperformance in the first 3 quarters highlights the strong fundamentals of our business and the continued momentum of our growth and profitability initiatives. As a result, we expect to finish 2023 ahead of our refreshed 3-year plan presented at the Analyst and Investor Day in August, while accelerating our path to achieving the Rule of 40 in 2025. We expect Q4 revenue to be 400 to 405 million or 13 to 14% growth. Due to the outperformance we experienced in the first 3 quarters of 2023, we are increasing our outlook for full year revenue to 1.558 to 1.563 billion, or 12 to 13% growth, an increase from our previous outlook of 11 to 12% growth. In terms of the valuation, it doesn't have earnings for a full year yet. However, it's getting very, very close now. But it trades at 4.2x sales, 6.4x gross profit, and 45x free cash flow. Although, as mentioned, a lot of the cash is going out for the new headquarters. So if you actually do normalized free cash flow, I've not worked out what it would be, but it would be a lot cheaper than 45x. As a shareholder, I think the valuation is looking pretty reasonable. The results are very good. It's a business, I mean, it's not grown into its valuation, but more it's the valuation shrunk into the business. But in terms of the share price, it's obviously took an absolute hammering over COVID. So it reached a high in COVID of about $348 a share, and it's now about $112 a share. I checked the other day, and I think my average cost of buying in is about $120 a share. It's been as low as $70 a share. Oh wait, that's in the last 12 months, but it's actually been as low as about $60 a share. So I was down about 50% at one point. I'm almost at break even with it. That's how well it's doing. So yeah, I'm very happy with these results. I actually think the valuation I bought it at was actually quite fair, because it's not far off that valuation. It's putting up quite good results. I'm fortunate that I didn't buy it at the peak of $348 a share. But yeah, I'm very happy with the business and how it's doing. It's not made me any money yet. However, it's getting close to at least not being a loser, which, given how some of the other COVID stocks have performed in the last few years, I think it does show the quality, that this business is still putting up the results. And I think it's dropped down to a pretty reasonable valuation now. And I do like the business and the product. So, John, what are your thoughts on Wix?
I mean, I think it's a great business, and those margins and the growth that it's been delivering are really good. But it was always probably a case of valuation for me. And yeah, when we had covered it previously and we were at those COVID highs, it seemed eye-wateringly expensive. I'd be more likely to take a sort of serious look at it now, and it having kind of grown into that valuation a little bit more, and not the sort of the eye-watering multiples that were being asked before. So yeah, I don't. There's not much I can criticize it on, and it obviously can't help its own valuation either.
So, of the 6 businesses we've covered this week, Inditex, AJ Bell, Currys, Supreme, Frasers, and Wix. If you had to buy one, which one would it be?
I think it's difficult. I think with my own money, Inditex probably, but if I were throwing caution to the wind, I'd probably go with Wix.
So for me, it would be Supreme, probably a no-brainer.
Yeah.
I already own it. I think of the businesses I don't own, I'd probably go with Inditex, but I don't really. I mean, in fact, yeah, I'd go with Inditex. It's by far the best one, I think, of the ones I don't already own.
Very good. Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.